Hey guys, it's Jordan here with Cashflow AI, and in this video, I want to talk about EV or expected value because it is the number one metric to determine if your strategy is going to be profitable in the long term or not. So let's dive into it. Now, the $10,000 question, you're all wondering, if you've backtested a strategy and it looks profitable, but you don't know if it was luck, you don't know if it's going to work with real money, how do you know it's actually positive? And the main question, how can you still have an 80% or a 90% win rate and still lose money? And the reason is because you need to understand EV or expected value, the number one most important concept when it comes to trading. So what actually is expected value? Well, it's the average amount you expect to win or lose over time. There's a very simple formula to actually figure this out. You simply multiply your win rate times your average winner, and you subtract that by your loss rate times your average loss. Again, it's a very simple formula, right? If your EV is above zero, your strategy makes money long term. If your EV is less than zero, your strategy loses money long term. And if your EV is $0, that means you're break even, and over the long term, you are expected to not make or lose any money. So how do the casinos actually use this to always win? Well, a good example is roulette. So let's say roulette, there's 38 numbers on that wheel. Let's say you bet $100 on red, right? 18 of the numbers are red, 18 are black, and then 2 of them are green. Okay, so if you win, you basically double your money. You get $200 back. If you lose your $100. Now you can do the simple math here, right? The win rate, well, there's 18 amount of chances you could win with 38 different numbers. That's a 47%. Your loss rate is about 52.6%. And so if you do the math, you multiply it out, you can see that your EV ends up being negative $5.26. Okay, that means on every $100 bet you put on red, over the long haul, you are expected to lose $5.26 on average. And that is for every $100 bet that you do. That's what they call the casino edge. That's a 5.2% house edge. So if you play 100 times, you're expected to lose $500. 1,000 times, you're expected to lose $5,000. So the more you play, the closer you get to this loss. And that's the key thing. Casinos don't care if you win tonight because they know they win over the long haul. Over millions of bets, they have a guaranteed profit because of their positive EV and our negative EV playing against them. So you need to be the casino when it comes to trading, especially in automated trading. You want positive EV just like the casino, right? Because if you have negative EV, you're going to lose over time. If you have positive EV, there's a very strong chance that over the long haul, you will make money. So you want to build trading strategies where you have the casino and you are basically the edge. So very simple example, coin flip game. Let's say that it's simple heads or tails with a coin flip, right? So if you win though, I'm going to give you $60. If you lose, you have to pay me $40, right? And obviously it's a coin toss, so it's a 50% chance. But if you do the math, your EV ends up being positive $10. Which means every single time you make a coin flip, you have an average expectancy of making $10 per flip over the long term. You play 1,000 times, you're going to make $10,000. That is what you want, is a positive EV. And a lot of people get that messed up with the win rate trap, right? Because people think, oh, win rate is the only thing that matters. You have an 80% win rate, so I must be profitable. But risk reward is the other thing that's important. A high win rate with small wins means you're not going to make money. Low win rate with large wins means you can be highly profitable. Size matters a lot more than frequency. So here's another example of this, right? Let's say you have a credit spread options trading strategy and you have a 75% win rate. Looks really great. Now, every time you win, you're going to make $50. Every time you lose, you're going to lose $150 on average. So if you do the math of the EV, you multiply, again, the win rate times the average winner times the loss rate times the average loser. This EV ends up being $0, which means over time, you're basically going to break even, or after commissions and slippage, you might lose a little bit of money. Now, the better strategy, let's say you have an iron condor strategy where it has a 65% win rate, where the average loss is $80, average win is $80, the average loss is $120. Well, if you do the math here, you have a positive EV of $10, which means if you continue to take this exact trade over time, you are expected to make money. And that, in a matter of averages, over 100 trades, you're expected to make $1,000. And number 3, right? Trend trade. Let's say you have a call debit spread strategy where your win rate is only 35%. Most people would get this, they would throw this out the window, right? But the average win is $300, the average loss is $80. Your EV ends up being $53 per trade. That's only with a 35% win rate. Over 100 trades, you're expected to make $5,300. So win rate does not matter that much. We can go into some more examples here. There's even a naked put selling one with a 92% win rate with a low EV, and you're expected to lose money with a 92% win rate. Again, because your losers are much bigger than your winners. So what's really important to consider is the win rate that you're strategizing, but also mainly the EV per trade. Because win rate does not always correspond to how profitable you're going to be. And in fact, in these examples here, the lowest win rate had the highest EV, the highest chance of you making profits. Now, win rate is meaningless if you don't know that, right? Like I said, what matters most is the positive EV or the edge. You never want to judge a strategy by just that win rate alone. You always want to look at EV or expected value. Another big mistake most people think is that, if you traded 10 different times, you lost money, the strategy doesn't work, but that's not the case. There is something called the law of large numbers, and this means that you need to take a lot of trades to happen to see the EV actually play out, right? Even a $50 EV strategy can have losing streaks, right? If you have 10 trades, it doesn't really mean anything. If you're trading more than 500 times, that's going to give you a much better chance of showing you exactly what EV can actually look like, okay? Now, there's another thing called variance, which is really important to understand as well. So let's say that you have a strategy with a positive $20 EV per trade. Now, after 10 trades, again, you could be still down $150, up $300. It really doesn't show you anything. And that's a pretty big difference, either being down or up in a whole trade, right? Now, after 100 trades, that kind of difference there tends to narrow, right? So you're likely to still see positive. After 100 trades, you're more than likely to see that positive EV come into play. But it may not be exactly that $2,000 with that 20 EV. It may be closer to 1,000, maybe closer to 3,000. Now, after 1,000 trades, the more trades you do, the smaller the variance, right? The more likely it is that you can basically estimate how much money you're actually going to make, because this is only a $4,000 difference when we're talking about 20 and thousands of dollars, okay? So you really want to look at having as many trades as you can to test if your strategy is actually going to work, and that's why casinos make profits, because they have people coming in every single day taking millions of bets. And that's exactly what you need to do with your trading when it comes to testing your strategy. So calculating EV step by step, all you have to do is backtest your strategy. So minimum 100 to 200 trades. I would say go as far back as you can. 2 years, 3 years is really good. You separate the winning and the losing. You see, okay, what is my average win rate? You calculate your average win, your average loss. Most backtesting, most platforms you do to even do backtesting will show all that information for you. And then you plug it into the formula and you see what your EV is going to be. And so a real backtest example, let's say you have 150 trades in a backtest. You have 95 winning trades where you profit 6K, 55 losing trades where you lose just over 5K. You do the math, right? 95 divided by 150, it's going to give you 63%. Your average winner is going to be $70. Your average loser is going to be $95. Plug it into the EV formula, and you make $9.44 for every trade that you take. This is a positive EV. This is a strategy that over time should make you money. So how do you actually create positive EV? How do you actually get the edge? That's the most important thing. Well, there's a few different ways to do that, right? Market inefficiencies. If you are different pricing errors that you can exploit, that's going to help you out. Statistical edges, right? There's certain patterns, supply demand, support resistance that you find work over time. Having good risk management is always important. Volatility mispricing is really big as well. Let's say you get a stock that just rips like crazy, like GME or AMC, whatever it is. Those options are going to be mispriced. There's going to be extreme high IV or implied volatility, which means if you're able to short those options contracts, you're pretty much going to have an edge in it of itself. The last thing, of course, is probability edges, right? Do you have a natural edge, a natural strategy that gives you an edge over what the market tends to do over time, okay? Now, they are hard to find, but if you can find them, that's going to be your golden nugget to go ahead and trade that strategy. Now, the other really important part is not just EV, but actually having proper position sizing. Now, there is something called the Kelly criterion. I'll be honest, I don't use it this much. I don't think it's the most important thing or the best way to calculate position sizing, but it is a mathematical formula that a lot of people use for optimal bet sizing on your edge. And it basically says to you, hey, if I have a $10,000 account, I don't want to be risking $5,000 a trade, right? Maybe if I had a 99% win rate, it would make sense to do that. But really depending on what your win rate is and your risk reward, you want to be able to do that, right? And EV is also not everything. You need to know your drawdowns, right? You need to know your Sharpe ratio. That's going to help show you your risk-adjusted returns, your win-loss ratio. You have to consider a lot of things when it comes to your strategy, not just your EV. However, EV is the foundation, okay? And if you don't have positive EV, none of these things matter. It's not worth doing or testing that strategy. Now, a few common mistakes to avoid: optimizing parameters until backtests look perfect. Let me explain something with this. You want to make sure that you aren't just creating the perfect backtest. So a good example of this is, like, let's say you have a backtest and it works and it looks really good. And then you say, you know what, let me just take out Mondays. What if we just don't trade on Mondays? We trade every other day. Well, you can create a chart that looks really, really good, but the EV can still be negative. So you want to make sure that you still have a positive EV after your backtest. Number 2 is ignoring fees. Very common one. Depending on which broker you're using, there's a few of them out there as well that Cashflow AI partners with that actually pays you to trade instead of you paying them commission. So make sure you're not ignoring the fees. And then 2 small samples. This is the most important one. If you're testing just 30, 40, 50 trades, it's not enough. You need hundreds of trades, if not thousands, to get a true sense of what your EV is going to look like. Now, more mistakes: look ahead bias. This means you're using information in backtest that wouldn't be available in real-time trading. Okay, there's a few different examples of this. This itself could be a whole other video, so I'm not going to touch too much on that. Slippage, same thing. A lot of backtesters kind of fill at the mid price. Most of the time, you're not going to get filled at that, so you got to look at that as well. And then changing markets. The markets are always changing. You don't want to just look at 2022 because it's going to be different than how the market performed in 2025. So you want to make sure you're paying attention to all of that when looking at your actual trading. Now, let's add a realistic cost to our iron condor example that we had before. So we had a $10 plus EV. Let's say we add in commission, so about $2.60 per trade. You're trading 4 legs, 65 cents. Let's add in $3 of slippage per trade. That's an extra $5.60 per trade that you don't really calculate or think about when you're running your back test. Now, in a real EV case, right, because you're taking your actual EV, or sorry, your one before the fees, and then your real EV, you're looking at $4.40. It's still positive, but again, a lot of the edge was eaten by cost. So you want to make sure you factor all of that in when it comes to your trading and your testing. Okay? Now, the other thing is that, again, your EV can change over time, right? If my EV is $4.40, it may be like that today. It may not be like that tomorrow, right? Because the more trades you take, your EV is going to change. And it may change in different environments, right? If you're in a low volatility environment, it may be a positive EV. And then when it gets to high volatility, it may drop to a lower EV. And that's actually really important and good information you can use in your strategy. You can simply say, okay, when the VIX gets above 25, don't trade the strategy. And then you maintain a positive EV over time. So you want to make sure you're looking at it in different environments and having all that up to scale. Okay. Now, and again, you want to make sure that you're using multiple strategies because you're going to get much smoother returns. So if you're able to combine having something like a mean reversion strategy along with a trend one, along with an iron condor, if you can stack multiple EVs in your favor and have strategies that kind of go against each other, like if you had, a debit spread that was in a trend versus an iron condor, those ones kind of go against each other. But if you're able to get 2 strategies that both have positive EV over the long haul, that's a really amazing thing to have in your favor. Now, the biggest battle with this is that you can have a positive EV, but still have really strong losing streaks. And it may last very long because you got to look at your strategy over the long haul, right? You may have also low win rate strategies. You may have a strategy that wins 10% of the time with positive EV, but can you mentally handle losing 9 out of every 10 trades that you take? That's a question only you can know. Not many people can. And a lot of times you're going to question the system. You may be 50 trades deep with a positive EV and you're still kind of not at that profitable stage where you want to be. Questioning things, you got to be able to handle that. So the important thing to know is that if your EV is positive and your sample size is large enough, the results will come. It is simply a game of math. Now, your action plan from watching this video: first, never trade without calculating EV. First, if you do not know your EV, get a backtest your strategy on 100 to 200 trades, include all the costs, commissions, slippage, spreads, test it across different market conditions, different VIX environments, and see, do you have a positive EV? If you do not have a positive EV, you should change your strategy to find one that is positive. Then you want to look to track your live results and trade it live, compare it to the backtest, and be patient. And once you get one, you can build a portfolio of multiple EV strategies, and that's where the biggest institutions have been able to make millions and millions of dollars. So I hope you guys did enjoy this video. We'll have many more on our channel. Feel free to check out any links I have in the description. And we'll see you all in the next video.